Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I'm delighted again to be able to speak to Laurence Hulse of Dowgate Wealth, one of the UK's finest small cap investors. So welcome, Laurie.
Good morning, Paul, and Merry Christmas to you and all the listeners. Really delighted to be back speaking to you all after a year or so of not taking some time out, but building a new investment company. So delighted to be chatting today.
Yeah, well, it's been far too long, that's for sure. And we had some good news overnight with the Fed having a sort of like another dovish pause and indicating through the dot plots that interest rates in the over states is coming down sort of 75 basis points as inflation has cooled. And we have some important Bank of England decision this afternoon, also by the ECB. So hopefully they'll also follow the same sort of like tune into as we sort of go ho 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 into Christmas. So putting all that together, what's your sort of outlook for equities into 2024, particularly your sort of sweet spot of small caps and special situations? Because I mean the market's on fire this morning.
It is, and look, there's been a lot of copy and speak around markets and where we are, all produced by much more intelligent people than I. And I'm not an economist or a tarot card reader or anything else, but what I can comment on is there's definitely been signs of life in the small end of the market. Whether it's an interest in capital raises again at Dowgate, we have a corporate broking arm. All of a sudden, they're very busy with interest and leads. M&A, which we'll talk about later, which is really at least some parts of the market see value and are putting their money where their mouth is. Most interestingly, recently, and especially today, is the AIM and small cap markets outperforming the larger and mid caps for the first time in some time. And that really does imply investors starting to want to target earnings growth and sort of more positive sunny uplands again. And finally, just chatting to peers and colleagues. I was with a couple for breakfast this week and with another last week. Signs of inflows and definitely outflows slowing, which part of the problem with AIM has been just forced selling from sort of fund managers having to indiscriminately raise cash in an illiquid market. I think, look, before when I was doing my prep yesterday, I was going to comment, are we there yet in terms of a real market rally bonanza moment? Well, I think when it's there, it'll be like stepping on a rake. It'll really whack you in the face. And until this morning or last night in the US, we hadn't quite had that moment. CPI printed in November had elements of that, but this morning and last night, the US markets are really motoring. And again, another indication that confidence is there. And as I say, it's like stepping on a rake. It's poof.
Yeah. Well, I'll certainly have a mince pie on the back of that, that's for sure, because it does feel as though we're starting to get that sort of vaccine moment as we did in November 2020 when sort of small caps really had that strong rally. So let's just take one step back, because you mentioned the sort of the signal or the implications of that M&A market. I know I did notice in your portfolio you've had some pretty good home runs, the DX Group and STM, and then more recently smart metering systems. So obviously you've got plenty of cash, or you will have some plenty of cash coming your way. But how do you sort of interpret this sort of like M&A surge, particularly over the last 3 months in small and mid caps in the UK?
I think it's a myriad of things. There's a liquidity mismatch. So private equity have lots of dry powder built up in 2021 when fundraising markets were strong. That's set against that AIM small cap market I've talked about, where actually cash is coming out. And therefore there is buyers with money to spend here and companies that are seeing outflows and buyers that are seeing outflows over here. So there's cash really transferring from private markets to public and sucking companies across. I think it's also private equity and trade consolidators. They work off very long-term 5-year plus return models, and if you are with a 5-year mindset, years like this are the ones to really deploy capital. They become what they would refer to as sort of vintage years, where you buy companies on a depressed multiple, the interest rate cycle eases, the macro returns, and you look back halfway through that 5-year thesis and think, God, wow, we've made a cracking buy there. And they're just taking a longer term view that we do ourselves as public markets investors, but you have to have cash to be able to do that. Private equity investors do at the moment. Public markets typically don't because of outflows and the market conditions you're seeing. That's really meant that over the summer and into sort of the winter, our cash position has evolved quite dramatically. So in Onward Opportunities, which is an investment company we floated in March, we obviously started off 100% cash. And until about the end of the summer, we were at a sort of 50-50 position where half in gilts, half in equities. Seeing some of the early green shoots of what we're talking about here, we have dialed that up and are now sat at more of an 80-20 position.
Right.
Now, the 20% cash is really held back because we think in the new year, whilst markets are priced to improve from here, the macro is not a sort of Hail Mary off to the sweetie shop next year and it's all going to be great. I think we're holding back a bit of cash for those companies that might get caught and need one last bit fundraise. What we've done tactically in the portfolio, which some of your listeners might find interesting if they want to run a similar mindset, having 20% cash does create a drag because on days like today, that cash does nothing and the market's having an absolute stomper of a day. So we've actually put in our nursery, which is our smaller positions, a position in Lion Trust and Miton Group, both of which we've been building really recently.
These are the asset managers, aren't they?
They are. They're UK listed asset managers. So their share prices have been really punished by all the themes that have driven the market down. And the logic really is that if the market, as it is today, starts to recover, those share prices can and will quite dramatically outperform the market and really almost hedge our cash position. And fortunate timing, but this morning you're seeing that play out live. We had that CPI print you talked about last night. The UK markets are really rallying this morning. And before I dialed in, Lion Trust is up 8 or 9% and mine is up 3 or 4. And what we really like about those is you're paid to wait. So whilst this plays out, Lion Trust, you're getting a 12.5% dividend yield and Miton, you're getting 10. So it's a tactical position. While those stocks you're having a kind of core position, maybe not, but it's a bit of tactical portfolio construction that the listeners might find interesting.
Yeah, no, you've raised a really good point there. Obviously, with that income it is generating, but also the high beta sort of like play on the small and mid cap market. But just for sort of like old asset managers in total, you just say they've been massively beaten down. Isn't there a sort of like a longer term value play as you have consolidation across sort of like Premier Miton and Lion Trust? Because Premier Miton recently bought Tellworth, I think, and obviously, and you guys have just picked up Adam Rackman's team, haven't you? So when you look at that and you've got good brand names, is there a valuation argument to it, as well as obviously a dividend and a beta play, which makes total sense from what you've just said?
There definitely is, and well, certainly at the time of purchasing both those shares, they were part of the single-digit PE club that one of your contributors consistently refers to, Jamie Constable, and that's a PE on what you could argue is a very depressed earnings number because these are businesses that have seen outflows from their funds and management fees under pressure. I do think there is a kind of M&A consolidation angle to it, and we see that as a sort of upside case that we'll revisit as and when this short-term return story plays out and decide what to do with the shares. There's others like Asset Co in the mix. You're totally right to flag that point.
Yeah. Okay. Good. Well, let's move to sort of like other stocks, and we'll sort of like as we go through, we can highlight some of the sort of core investment principles as what you look for. And I know let's turn to the consumer first, because this is another geared play on the economy. It's been through a bit of a cost of living crisis, to say the least. And one stock, Angling Direct, has definitely been through the mill over the last 18 months, and it sort of like does all things sort of like fishing tackle, I think, in the UK, and has been branching out abroad. And what's your view on this one, and what's the investment thesis?
Look, I think I'll hands up, retail is not a traditional stomping ground for my investment style or how my mind works. That said, we have at the moment got 3 stocks in there that we'll talk about today in that sector, and it's really a reflection of that tough time they've had, and therefore sort of trough multiple, trough earnings type mindset. With Angling Direct, it has some of the more attractive qualities that you might look for in a retail business. And what do I mean by that? Well, the business is very well insulated from a further downturn. It has about 15 million of cash versus a market cap of, I think, 23 when we bought and about 30 now.
Yeah.
Its end customers are quite interesting. So the demographic of a fisherman, Paul, they're probably somewhere between your age and mine. Plus, a lot of them have been net beneficiaries of rising interest rates because they don't have a mortgage, or it's very small, or they've got cash in the bank. And it's a hobbyist type mindset. So especially because the bait is live, you have to go back to the store and it's repeat business. And it's quite fairly inelastic versus something more disposable or luxury. So there's things to like. That said, the business has been through the mill a bit, and it's really why we've got quite an active thesis on that one, as people have seen from our fact sheets and report and accounts and whatnot. And what we think we've identified is sort of dual optionality on upside and almost, dare I say it, a win-win type scenario. So the business as it stands has two divisions. It has a much larger core division, which is really the UK business. It's got 40, 50 stores, a really good online market, and together they're about 75 million of turnover and throw off about 5.5 million of underlying EBITDA. Really versus our entry EV of about 8. So we feel like we've bought a good asset really attractively. The question, that's a good business, and actually we think they should accelerate growth there because it's higher ROCE, higher margin, and it's proven it's lower risk. The question really comes up, and where we're working with the board, and this is not a call here today to slate them. Andy and Steve have done a fantastic job on the UK business, and we really, really like it. Without that, we wouldn't be investors. However, they've been trying to grow in Europe for the past 5 or so years, and there's definitely merits to why they've considered that. It's a market 3 times the size. It has some of those same attractive qualities. However, it's not really worked so far, and the business is not really broken out in terms of growth. They're selling at a much lower profit margin, gross margin, which is generating losses at the group level. And we just think there's a bit of a question mark there. And fishing itself is a game of chance, really. And the whole reason why customers go to Angling Direct is to buy widgets and lures and bait to maximize their chances of success. And that's really how we think as investors. We want to encourage the management team to really focus their efforts on taking the UK business from a turnover of 75 to say 100 million, which they think they can do. Do that through accelerated store rollout, use some of that cash balance. And we think that much stronger market position, that would take them from a market share of about 12 to more like 20. That would give them quite a powerful position in the value chain to increase their gross margins, which will increase their profit margins. So if you say, did 100 million turnover in the UK, knocked out 7 or 8% EBITDA margin off that versus about 2 or 3 they're doing as a group at the moment, partly because of those European losses. All of a sudden, that should be a 6, 7, 8 times multiple business. And that does give you an EV of about 60, 70 million versus 30 today. So we just think there's a slightly more simplistic route to upside. Maybe narrow range of reward outcomes, but also a narrow range of risk to match. And I'd just encourage listeners to continue to track that story, because it's quite a nice little active thesis we got there. And so far it's gone really well. It's one of our top performing stocks.
Yeah, no, that makes perfect sense, actually. Stick to your knitting. You've got a good brand in the UK. Concentrate on that one, and where you can make profits and get economies of scale. You don't need the marketing, obviously, associated with putting a new business into Europe, and therefore you drop out all of those those sort of costs. The one question, I guess, that I've scratched my head on is that, given that it's got an established brand in the UK, and let's assume it does focus on the on Britain, etc., and it has relatively sort of price insensitive kind of customers, how come the margins are so low even in the UK? Because if it does a sort of like a 80 million of turnover in the UK and sort of 5 or 6 EBITDA for a price inelastic type product, I'm stunned why there isn't opportunity to increase the gross margin on that.
Totally agree, Paul, and it's why we are active on this one, because
good. I'll leave the heavy lifting to you then.
we agree with you. Look, I think if you look at the fishing tackle market, there's 2 things I'd point out. So until Angling Direct really consolidated the market 8, 9, 10 years ago, it's a very, very fragmented market. So the retailers have historically had a very weak bargaining position with suppliers. And all those suppliers are big global brands owned by private equity. And we know how they operate. They are sharp operators.
Yeah.
They're generating 70% gross margins. The retailers 35. So the key is to really move that ratio and negotiate stronger with the suppliers. Now, you've got a lot better bargaining position if you're the clear market leader and really cornered the UK market at a sort of 20% market share versus 12.5 today. And that's why we're really keen to see them accelerate growth in the UK, because not only do you get the higher turnover number and higher profits at a flat percentage operating return, but we think that higher turnover, that higher market share will actually allow for some percentage margin upside through a stronger but really bargaining position with the suppliers. The other thing I would point out from having that higher market share is you then become quite an interesting asset or platform from a sort of global retailer. So Pure Fishing in the US was bought 4 or 5 years ago. Svendon Sport in the Nordics was bought last year. And then Frasers are on a real retail roll up at the moment, aren't they? And JD Sports own Fishing Republic, which is the second largest UK retailer, and I don't think there's any love lost there between JD's team. So for us, it's all about maximize the good asset you've got, drive better operating return, and then see what happens.
Yeah, and with the cash in the balance sheet, they've got a strength to be able to go through those rationalisation or restructuring if they need to. Yeah, get it. That's good. Sounds good. Now, just a bit further up the sort of the market cap scale, we've got Wetherspoons, who do seem to be doing really quite well, actually, given they're sort of like more of the affordable type sort of pubs with drinks and food, and I think even sort of like lodgings and stuff like that. I don't know whether they've sort of picked a sort of like a copy cut for Greg's, but they do seem to be doing pretty well. I had like for likes of about nearly 10%, I think, the last sort of count, etc. What's your latest on this one? Because it's a very big liquid stock that seems to be doing pretty well, actually, in these tougher times.
Yeah, I mean, in the small cap fund at Dowgate, which is a slightly wider mandate, can go up to sort of 2 billion or so market cap. We see this as part of our sort of affordable fund theme that we've been really tapping into over the past 9 to 12 months. Look at things like 10 Entertainment Group that were bought last week. Similar idea, and I'll come back to that one in a bit. You've got an entry-level pub chain. The consumer is under pressure, but doesn't want to sit at home twiddling their thumbs either. And I think anyone walking home from work the past few weeks has definitely seen that. And Tuesday was sort of bacchanalia when I was walking the tube. I couldn't quite believe it. You've got a charismatic founder who has recently invested quite heavily personally. I think about £7 million check he wrote, and that's at a higher level of previous purchases. So our thesis is a consumer looking to enjoy themselves but at an affordable entry-level rate. That's very much Wetherspoons when it comes to drinking and socializing. But that's really the turnover story. I think within that, JD have been really suppressing their margins and absorbing price pressures to protect their consumer, their customer, who they're very loyal to. They are now, as real incomes start to recover, they are sort of publicly stating, sort of trying to open that back up and recover some of that now that they've helped out their consumer in the toughest period. I suspect that's really what's behind the directors buying and the improving earnings forecast. I think in my notes, a 2% price increase they pass on at the till has a 40% drop through to profit. So we think there can be quite a good margin recovery story from 4.5, 5 up back to nearer 6 and 7, which is the structural normalized margin, and that's quite meaningful versus where the shares are today. And I think you're seeing that being recognized now, and the shares have had quite a strong move the past couple of weeks.
Yeah. Oh, I would agree. If people want to go big cap, then it looks a very sensible play. Now, again, coming down the scale a bit, we've got Comptoir Libanais, which I think does Lebanese sort of restaurants in the UK and sort of Eastern Mediterranean, and then it also has got a bit of a franchise operation abroad in other territories. What sort of attracts you to this one? Because it's a very specialist type of restaurant chain, Lebanese food, and it's a bit topical, obviously, at the moment, given what's happening in Gaza, etc. But it's probably been hit a bit by sort of like the train strikes and also sort of like energy inflation and stuff like that. But putting all that together, what's your sort of outlook for next year for a sort of like a specialist restaurant group like this?
Well, I'm almost tempted to not talk about the company at all and just say to listeners, get down to a restaurant. And
Oh, you like it, do you?
well, and while you're there, the EV is about 1.5 million at the moment, and
Yeah,
it does
okay.
a turnover of 30 and it's profitable. But I do that, but I will walk you guys through the thesis. I think it's a business, again, had a tough time through COVID, tough time through the consumer recession of the past 18 months, but it's actually traded pretty resiliently. You've got 24 restaurants and 6 franchises. They throw off a turnover of 30 million. We think they do a normalized EBIT of about 2 to 3. And they had a tough past 12 months just because of the energy price and input cost inflation, but that's unwinding now. And they were still profitable through that. But so you get that turnover and that profits recovery, but the market cap's 7.5, and they got 5.5 or so of net cash. So it's a very, very small EV to buy some optionality on a restaurant recovery story. Now, I think that's the entry valuation argument. What's quite exciting about us in terms of really getting back to that EBIT target is 2 to 3-fold. First of all, very high quality board have gone in over the past 12 months. You got Beatrice Lafon, who's sort of known as Mrs. Fix-It in the private equity world. Very impressive chair, ran Claire's Accessories as CEO for many, many years. Real proper big business experience. She's gone in this chair and really dovetailed with Nick Ayerst, who's come in for the restaurant group, which is obviously quite topical. Yeah, he was there for sort of 20 or so years, referenced very strongly. And they are putting in place a really creditable plan to restore the business to former glories and then grow it again. What do I mean by that? Well, initially they focused on the existing store estate. They closed 2 loss makers and they refurbed the existing estate. That's why the net cash figure has come down from what was 7 to that 5.5 number I gave you. And that's seen the net promoter scores of the sites nearly double, which is really important. You go to these sites, they're full of color. It's a visual experience. The name Comptoir literally means food for all. And it's back to that affordable, accessible, fun and leisure theme. It reminds me of 10 Entertainment Group in some ways, right, on that basis. So the sites are great. They've revamped the menu, delicious food, full of color, affordable. And now, interestingly, they've got the confidence to return to growth. So they RNS'd about 2 months ago, the first site opening in 4 years, which was in Ealing. That's got off to a really good start and given them confidence now to, I think last week they RNS'd a new flagship site on the South Bank by Waterloo. We think they're having a really busy Christmas. I actually run past 2 of their sites quite regularly on my way to work. So it's a proper cigar butt investing type mindset, but they're definitely having a busy Christmas. Cost inputs are the issue at the moment, but the most important thing with a restaurant chain is, can you sell? And then we'll see that translate into profits as they normalize conditions, probably next year, year after next. But you're really not paying much for that upside. And if you apply quite a sensible multiple, nowhere near the one TRG commanded, you can quite quickly get to a sort of EV of 20 million. And that's really sales go to 35, 7% EBIT margin, that's 2.5 million of EBIT. Put it on 8 times, that's a 20 million EV versus a market cap today of 7 and 5 of that is cash. So there's definitely upside here if they keep doing what they're doing.
And what's the liquidity like in it if people wanted to buy that share? Because 8 million market cap may suggest that it's quite difficult to get in and out.
Well, look, in terms of entry, that's the obvious challenge. But over the past 6 months, we've really quietly hoovered up 8-9% of the company,
well done.
So continuing to do that. In terms of exit, it's not a business that should be public forever. It's too small, as you've rightly flagged. It was actually the Fulham Shaw deal that got us to look at this originally back in April, and there are a lot of similarities. And you've got a founder who owns a decent stake, super committed, very, very impressive. Actually, with him a couple of weeks ago. But at some point, he's going to need an exit, and so will other shareholders. So we suspect it's one to run and hold, and then you might see us as a strategic shareholder work with the board to maximize shareholder value.
Okay, good. Well, let's pivot to another sector. Let's talk about industrials. Now, companies, let's kick off with Transense Technologies, which has been around for absolutely ages, I think, and has patented sort of like surface acoustic wave sort of sensors. I think it originally started for sort of tires to be able to look at tire pressure in cars, but I believe it sold that business or effectively licensed it out to Bridgestone about 3 or 4 years ago or something, and now is sort of concentrating on sort of wireless sensors for other industrial applications. Do you want to take us through this one, because I'd written it off years ago, so I'm really interested to hear what the investment thesis is on it.
Yeah, look, I think that's one point in time, it almost become a bit of a laughing stock as a stock. And agree, it has a very checkered past, promised the world, never delivered. But I guess that's the key word, the past.
Mm.
And look, this is definitely the one you get most challenge on when I talk people through the portfolio. But as I'm about to reveal, we've got some quite strong thoughts and evidence why it may finally be now happening. So something changed in the business in 2019. The history of the business has been one of losses, fundraisers, failure to execute on the technology. In 2019, a story started that righted those three wrongs, and that's why it's now a profitable business, generating cash, buying back shares, etc. And a lot of this is down to Nigel, the exec chair, who's done a fantastic job of steadying the ship and now getting the business humming. So in 2019, the business has three technologies, I should explain to listeners. One's a tire pressure monitor, one's a tire tread depth monitor, and the other is a torque sensor.
Yeah.
And we'll go through them one by one. 2019, the tire pressure monitor, which was definitely the most developed of the three technologies and where the business has been sort of desperately focusing. Nigel oversaw a royalty agreement to Bridgestone on that technology. So basically, they are installing the sensor in all their mining truck tires. That is generating a royalty revenue, 100% margin of about 2.5 million per annum. It'll peak at about 3 and then tail off back to 2. Yeah. That's got 7 years to run, and those accumulated cash flows underpin the current market cap, i.e. they're worth the same as the current market cap. So that was the interesting starting point, but in itself, okay, well, there's not much upside there. What it's crucially done, though, is de-risked the investment case. No more fundraisers, underpins the current valuation. But it's also, because there's no more work to do, they just take money from Bridgestone. It's freed up what's now been 4 years to focus on the other two technologies. And that's why all of a sudden, after 20 years, you're seeing these things win orders and contracts under a new sales director, Ryan Moorhan, who's very, very impressive, been buying shares himself, PA, as is Nigel, the chair, and the Neds and the finance director, all very recently. Ryan comes from a components background and is really quite excited about the genuine level of IP within the business. I'd say within our investment portfolio, the highest moat in there is in this business. And that's why the torque sensors and Translogic, the tire tread depth sensors, generate gross margins between 80 and 95%.
Wow.
That is serious pricing power implied. And in the tread depth area, they've got the turnover up to 1 now versus zero some time ago. And we think they're having really exciting conversations with fleet management type operators, maybe the Halfords of this world, where we model that can become a £4 million turnover business over the next 3 or 4 years.
Is it basically a tire tread monitoring on a vehicle, or is it actually a diagnostics at their sort of like the Halford sort of like repair centers?
It's a handheld tool that links up to RFID QR tracker and a piece of software to really monitor the fleet every day. Because for fleet operators, it's all about maximizing life of the tire and avoiding blowouts, so safety and efficiency. And it's a really good product for that. That's why they're starting to win business for the first time. They're actually giving it the love and attention it needs. As I say, we think that can go from 1 to 4 million of turnover. That's versus a Transense market cap today of about 15, which we think is underwritten by the royalty incomes from the first technology. Okay. And so all eyes on further progress in the near term on that. Longer term, what's the real sort of Shangri-La moment for the stock if it happens, and what really investors are looking for is further material progress in the torque sensor, which is called SAW, surface acoustic waves. We've done quite a lot of work on this technology because it is key to the investment case. And what caught our eye was two early contract wins. One for the Department of Defense to retrofit 5,000 helicopter engines, basically Apaches and Chinooks. That's a really high barrier to entry market, especially for a non-American company. Okay.
Yes, I know.
So interesting. It must at least work. It's not the biggest contract in the world, but it's a real good sort of rubber stamp that this stuff works and will pass the highest performance standards and security standards. Then a similar scenario, but in high performance motorsport, again, real high, high end, high barrier to entry market. They've won IndyCar with McLaren Applied Technology and now Le Mans as well. And we think they might win other motorsports where McLaren are involved in as well. And again, these aren't multi-million-pound contracts, but if you start to have these in the slide deck as case studies and really meeting those RFPs and standards, we're now getting quite excited about what the companies say they can do and what we're starting to think they can do in larger scale opportunities like agricultural machinery, robotics in factories and plant machinery, electric drivetrains. And that one's particularly relevant because typically torque is measured in two ways: with a magnet-based device, or with a sensor that actually measures flex in the drive shaft. Now, if you've got to flex the drive shaft, clearly by definition impacting its structural capability. And then if you're doing it with magnets, well, electric motors actually generate magnetic interference because they're big magnets themselves, effectively. So there's a really interesting, Steve Parker, who's joined the board, he's on a subsidiary board at Mercedes, really articulates this much better than I will. The time could really be now for this technology in automotive, because you need, electric motors are all about range anxiety and efficiency. So being able to accurately measure torque in a way that's not interfered with by electromagnetic radiation could be quite powerful. And
is that to identify where there's failure, there's a problem operationally, or is it just to improve efficiency?
It's to allow you to run near the performance threshold of the drive shaft and the motor. And there's some great web videos that recently added to Transense's websites. Go and watch them. And the other thing I pay note to: consistent directors buying over the past 6 to 12 months, and recently approved very large buyback as well. So they're either sort of crazy or quite confident. And there's a really interesting series of tables in the past 3 sets of interim and full year accounts that track the emerging pipeline, and it's quite detailed, and you'll see it's growing quite fast. So we think they are on the cusp of some material success there.
That is an absolutely really smart idea there, Laurie. I mean, I would highlight to investors, if you're interested in Transense, and I certainly wasn't before this conversation, but will now, if their technology, this acoustics or sort of like sound wave sort of technology, doesn't, as you say, interfere with electric motors, but improves the power transmission and efficiency of those EVs, given that they have a battery life problem in terms of sort of like, not battery life, but basically the energy. If it can extend the range by any amount, then that's a fantastic breakthrough. So yeah, I'll have a look at that myself.
And just the one thing I flag is that they openly talk about talking to electric car drivetrain manufacturers and others. Just go and look at their report and account.
Yeah, I will.
And then the other is, SAW is 90% plus gross margin. They don't have to win loads of work here. It just drops through to the bottom line, because they own the patents. And the customers then design it into their product. So it's could be super attractive business model.
Yeah, well, thanks for that. Okay, well, let's move on to another industrial. We've got MPAC, which does sort of like all things sort of high speed packaging machines, and also end of production line like cartoning, etc. It does mainly equipment, but also does services. And I think it's sort of its traditional bread and butter is looking after FMCG businesses and health and biotech companies with sort of like blister packs and packaging and those sort of stuff, but has now just recently got this big contract with Freya out in the States to help them sort of manufacture or package sort of like EV or electric batteries, etc. Do you want to take us through this one? Because I mean, at the height of the pandemic, it was at about £6 or £6.40, and has come down to £2.10. Has cash on the balance sheet, and has a big chunk of revenue. I think its EV is 40 million. Its turnover is over 110.
Yeah, it's a nice simple thesis, this one, and a simple business. So they design and build automated packaging lines for big companies. So if you think, I don't know if anyone watches How It's Made, but when you see those tissues flying to boxes really fast,
that's right. Yeah.
So there's some interesting structural themes: automation, robotics, and they're in quite defensive end sectors. So pharma and food and beverages, as you say. The business had a real annus horribilis last year. It's a very component-heavy product. How many widgets and chips and spinners and whatnot in these production lines. The supply chain clog up last year meant that they just took a lot longer to deliver the orders they were working on. It created a working capital draw, a gross margin hit where they paid up for stock. And what that meant is this year they are going to produce a depressed EBITDA number, but we're 4 weeks away from the year end, and actually the earnings number for next year is a lot higher, so the stock's on a 5 times PE for next year.
Yeah, I know, 5.5. It's crazy.
Really interesting starting point, and that's why we met the company. But then we sort of uncovered beneath the bonnet something quite interesting going on. So new chief exec from JCB, referenced him extremely in depth. 4 or 5 former colleagues. He did a fantastic job there. I mean, just go and look at his LinkedIn leaving post. I've never seen anything like it. It's about 500 comments.
This is Adam Holland, is it? The new
Adam
guy?
Holland, yeah. A physicist by training, literally a rocket scientist, but very, very eloquently. You'll see that in his recent sort of investor video. But he's a very capable operator, very smart man, lots of experience in dealing with global companies and improving profits. At JCB, where he turned around their turbine division, and it's now actually a crown and the jewel at JCB, but when he took it on was a bit of a mess. He's got a very clear plan to double the turnover from 100 million to 200. That's really from a bit more of a systematic sales and marketing process. The business was a bit inward looking before, I think. Made a couple of big sales team hires, potentially from a larger competitor. So he's got a very clear plan to take it from 100 to 200, just from really doing more of what they do better. It is a lumpy business. Sales are 2 to 3 million, turnover is 100. So, I mean, the upside is it's quite easy to grow quick because 10 orders is 20 million, 10 new orders. But that's why it's important to grow, to just dilute some of that lumpiness. But on top of that, he thinks he can get the margins to 10% plus. So that would be, we think he'll actually do 12 because they've got a growing service element, as you'll see in the accounts. If you do 200 million of turnover, 12% operating margin, that's 24 million of EBIT. It's very low D&A business, by the way, very capital light. Put it on 6 times, 24 million, 6 times, that's 144 versus a current market cap of 40. That's our base case thesis. And you've hinted to it, Paul, you've rightly spotted it. What may happen beyond that later out in our thesis is batteries comes alive, and it's a packaging business doing in batteries. Well, the history of MPAC is originally it was the Mullins business packaging, and then they used that expertise to package tissues. Why did they do that? Fags, as anyone that smoked or had a cigarette in their life will know, are very, very delicate, as are tissues, and packaging them fast at high speed is quite a specialist skill set, actually, and that's why MPAC have a 30% share in what's called side loading in packaging. It's probably not by design, but about 7 years ago, they realized that this very delicate, high-speed, sensitive packaging capability is exactly what you need to mass-produce batteries, because they're very volatile and very sensitive and very expensive.
Right.
They're signed up so far with Freya and Ilika, both of who talk about them publicly, as their preferred partner to design packaging production lines for batteries, i.e. putting the casing around the chemical anodes and cathodes. Why is that interesting? Could be a very high growth market if they are the winner. But also, quite interestingly, battery production lines are bigger and more complicated. So a typical order there, we think, is 6 to 8 million versus 2 to 3. Right. So you don't have to win many of these things to make a real big impact on the turnover of MPAC. So excited about that one. Other catalyst, they've got a pension surplus, certainly from an accounting perspective. And we think they're already progressing optionality on that to really insure it and buy it out. I think that'll remove a slight overhang on the stock and actually probably makes it an easier takeout target one day. There's some real big tier 1 players that I think, like people like Syntagon, PE owned, I think if MPAC planted the flag in the battery market, that all of a sudden make them quite an interesting bolt-on for some of these £1 billion+ businesses. Great chair, great CEO. Again, recent directors buying, do what they do, not what they say, kind of mentality, a bit like Transense. So that's how I'd summarize that one. But yeah, been to £6, back to £2. We like it at £2 and think it could be worth £1.6 one day.
Yeah, I would agree. I mean, even without any of the growth in that EV side and the battery side, then it's still very, very, very cheap. And also, I guess at some point in time, it will probably end up paying a dividend as well. I know it has suspended it, but I'm sure they'll do that. Okay, let's move on to another industrial one, more on the sort of like the equipment hire, Speedy Hire, which again has been through the ringer. I think it was at about 75p about 2 years ago, has come down to just over 30. It has a bit of debt, but it's less than 1 times EBITDA, etc. And it does sort of like all things of sort of like, rented equipment for the construction industry and DIY. And it's got a sort of expanding its digital presence, as well as actually it's got a bit of an interesting relationship with AFC Energy, I think, in hydrogen or something like that. But take us through this one, because the shares are battered. And I suppose if we do get a better economy, or less worse economy, then it should have a big gear play on GDP.
Yeah, the shares are battered, I think, for 2 key reasons. Where the construction sector is at the moment. Well, as longer term value investors, that makes it interesting to look at, not off-putting. And then this is one that's been victim of that sort of death by 1,000 cuts to small cap and AIM fund managers' liquidity, because it's just one that suffers. As soon as everyone has an outflow, you see the next day they're on there just slotting shares. I'm going to encourage viewers to just go and watch Dan Evans' Capital Markets Day video, rather than, I'll summarize what they're doing, but he's just really impressive. Dan's been in the business 25 odd years, started off, I think, running one of the depots as a site manager, and is now, as of this year, chief exec. He's got a really clear, he clearly knows the industry inside out, first of all, but he's got a really clear velocity strategy, they call it. I would summarize it as really using the emissions issue the construction sector has to drive Speedy Hire's sales and profits. That's where the AFC tie-up comes in. The construction industry is one of the biggest emitters in the UK. It's scrambling around how to reduce it, because sort of by default, if you're constructing something, you're using up resources. You can't have a virtual reality house just yet, thankfully. So one way that the Speedy have quite shrewdly identified is rental can be part of the solution here, because if you're renting a piece of kit versus buying it, well, you're having a slice of the carbon footprint, not the whole piece of owning the kit. But also, on top of that, they're sort of being first movers on zero emissions kit like hydrogen powered cherry pickers, and customers are loving it. They can't hire enough of these things and therefore build enough of them. There's an interesting angle emerging on sort of B2C type model as well. But again, I'll leave it to Dan's video. But the key numbers, we think EBITDA can grow by about 50% over 4 years. Should trade in about 4 times. It gets you to about 99p per share. And you'll get 14p of dividends over 4 years while you wait for that as well. So it's one of these big yielders again. I think the balance sheet's solid. It's an asset-backed balance sheet. They're targeting between 1 and 1.5 times, but their facilities could allow them to go to 3 times in a disaster scenario, which we actually think we're getting through the worst of that end market difficulty. But, solid business, great, interesting time. If you look over the years, Speedy Hire gets smacked at the end of the cycle and absolutely tears at the start of the next one.
Yeah, no, it's a high beat. In fact, it almost like falls into that asset managers plays, doesn't it? Because it's got a higher dividend yield than it has a PE ratio. So when you have that, then it's a good value, to say the least.
Yeah.
Okay, well, let's go through into a sort of like a more IP heavy industry. We've got EKF Diagnostics, which there's no doubt about it. This is a world-class leader in all things sort of hematology diagnostics, and it also does I think it does type 1 diabetes, sort of like tests for type 1 diabetes, and is now recently sort of like trying to expand overseas into the States to do specialist enzyme production for again sort of diagnostics and the healthcare sector. Do you want to take us through this one? Because I mean, its shares have been sold off, trades at around about 28p, 27p, etc., but is really IP heavy on this one.
It is, and the sort of two halves to the business. The core diagnostics business, which is a really attractive, razor blade model, as I think your listeners have heard plenty about in the past from some very esteemed peers and colleagues. That we think that sort of underpins the current market cap. It's probably worth a little bit more than the current market cap, maybe
agreed.
Share. But then actually, what we're really backing is Julian Baines, dual fix-it type mentality, coming back to really do two things. Return the core diagnostics business to growth, as I say, make sure that is really worth 35p plus. But really, and what's driven the downgrade and the difficulty has been this enzyme fermentation opportunity in the US. That's now finally on track. Julian's really got a grip of the timing and upscaling of that. The business is forecast, I think, to do 10 million of EBITDA this year and 11.6 next year.
Yeah, something like that. Yeah.
So that 10 number assumes no enzyme fermentation orders are won and executed on. Well, the company have now already announced they've had at least one and talk about inquiries. And this was back in November. So we think that's starting to pick up. And we think that also means the 11.6 number next year is now too light too. And together, you can see it. There's probably a near-term scenario where the group is worth 40 to 45p over a kind of 24-month view. So decent upside, not a kind of multi-bagger, but lots of visibility on it. And it's a really high-quality business, this one. And then longer term, we think it's worth nearer 58 to 60, depending on really 58 to 60p a share, just on the extent of execution and enzymes. It's much higher margin than the core business. There's a real supply constraint in the US, i.e. what they're building, they're going to have lots of customers who will want the capacity quite quick.
Is that right? I mean, another company said that, but is there, because I mean, they're sort of like targeting that mid-market rather than the sort of small production volume or the massive enzyme production. So is the demand strong for this specialized mid-market enzyme?
The demand is strong, and I think that's testament to our Liberation Labs and other business are writing a pretty huge check to try and build something similar, which would take sort of 12 to 18 months to complete. It's especially in the food market, so food production. Pharma, we think, is a great opportunity, but might be a slower, longer burn. But certainly in food production, enzymes are required quite heavily. And as I say, it's really driven the business's sort of quite material capex investment in the capacity here. And Julian, sort of very safe pair of hands. I think he would admit, but probably wish those hands had been a bit more tightly gripped over the past couple of years. But he's done the honourable thing and come back for shareholders to right a couple of wrongs and generate upside again. And there's early evidence of interest in this enzyme capacity.
Good. Okay. And I don't want to put you on the spot here, Laurence, but I will nonetheless. This looks like a jewel in the crown that's going to get taken out, particularly as we have a sort of surge in M&A. What would you say? I mean, obviously that's all optionality, but it does seem to be one of these perfectly positioned businesses that life sciences is renowned, isn't it? You take all of the gross margin and then you don't need anything below.
Paul, I think you're right to flag it. You can never base an investment thesis around this sort of thing. It's got to be a kind of upside or blue sky scenario. That said, you're right. There are qualities about the business that would suit it to being either part of a larger group or a private business. What do I mean by that? Well, the razor blade model, something like Abbott, or you could really just plug and play the diagnostics business into a bigger group, take out your PLC, central costs, and some other overheads and get a much better margin. And then the enzyme business actually could be a standalone asset itself, especially after 12 months of proof of concept. It may well be, you could see if there was an M&A scenario, it might be that's what, one division goes somewhere and the other goes elsewhere. But I think that really underpins how there's intrinsic value here available for investors at the kind of 28, 27p level. Again, and there's a bit of a theme here after a bit of an annus or two annus horribilis. But you've got some really sensible people on the board, sensible shareholders who will do right by shareholders, I suspect.
Yeah, no, I would agree. Okay, good. Well, let's turn now to all things house builders. And we've got two here. We've got Springfield Properties and Vistry. Let's go for Springfield first because they had a bit of a trading update, I think, only yesterday or 2 days ago. They're a Scottish house builder, largely, I think, historically from timber frame. They do private sales, but have moved also into affordable social housing. Really, really cheap, sort of 40% discount to net tangible book. But take us through this one, because the one thing which has scared me for some time is the debt, but that seems to be an issue that you're presumably quite happy with.
Spot on, and it's the debt that's the problem, but the potential as well. What do I mean by that? So Springfield Properties, listed, I think, 2017.
Yeah.
Has unfortunately, and it's, you know, how many times have we all said this, did a load of M&A at the top of the cycle. That was partly funded by debt, and it's left the house builder in a really tricky house building market with a lot of debt. So earnings coming down, debt's gone up, and banks are all a bit twitchy. And that's what's really seen the shares not quite collapse. I've seen some worse ones, but really, I think 200p to 50p. So yeah,
that's right.
Really, put it like that, it probably was a collapse. And that's really where we started looking at it over the summer, admittedly more like 55, 60, not quite the lows. But now the debt ordinarily would be a problem. But what we liked about Springfield, even before things got really quite tricky with the huge downgrade at the end of the summer, was it owns the largest land bank with planning permission in Scotland, and it's actually one of the largest in the UK. And we all, just pick up the Daily Mail or the FT or whatever it is. Planning is a big bottleneck in housing construction, and therefore that land bank is definitely a kind of realizable NAV. I think sometimes you have NAVs that the accountants say they're worth this, but when you come to sell them, what are they really worth? In this case, what we really identified is because of the planning permission is there, and you're seeing this now as I'm about to come on to, real asset underpinning that's going to allow them to really transfer the enterprise value into the market cap. What do I mean by that? The business is overgeared. They're selling down parts of the land bank to pay that down. I think they want to take debt from 95 to 55.
Yeah, that's right.
And they've just confirmed yesterday they're on track to do that by March or May.
Yeah, May, yeah.
That, even on a kind of multiple flat basis and earnings flat basis, that's a pretty huge transfer of enterprise value to market cap. You're starting to see that in the shares now, which are really behaving quite well. And I think to supplement that, again, to help ease the pressure on the business, they're going to, almost a bit of a history, which we're talking about next. Yeah. They're going to focus on social housing contracts, which are lower margin, but much better cash flow and ROCE dynamics. And between those two initiatives, we see quite an attractive recovery story from here, because the balance sheet risk comes out of the multiple, but crucially, actually, some of that balance sheet liability, as it's paid down, comes into your market cap, and you get an EV market cap, EV comes down, market cap, and you're there. And it's I think a bit like Lion Trust, those shares are behaving quite well this week.
Yeah, no, well, they're up 7% already today. Now, I guess the question that I struggle with on the house builders, I mean, I like the whole sector because it's just battered and stuff like that. It's got I think it's got a net tangible assets of 120p, Springfield. Is that realistic? Because if you're right, the thesis is correct as they start realizing the value in that land bank, and obviously they've got to deduct some of the capital creditors if there are any associated with it, but if they start realizing it, then it obviously track closer to 120. But if the 120 comes down because of write-offs at buying at the expense of the the top of the market, then that breaks the thesis. What's your sort of view on it?
I think that's definitely a risk, and why I probably wouldn't pay £1.20 for the shares, being totally open with the listeners and yourself. But as I say, we form the view sort of anywhere below £1, but especially at sort of 55, 60, 70p, that's more than in the price. And I think the market at one point was pricing not just the write down and maybe the M&A, but actually is the land really worth what it's worth? But fortunately, and this was an important part of the thesis, the first two land disposals have been profitable. So actually, not only are they proving they can sell it and sell it quickly, but they can sell it at more than the carrying value.
Right. Okay, good. Excellent. Now let's just go further up then. We've got Vistry, which again has sort of pivoted from private sales to a lot more sort of like social and affordable housing. It's run by a rock star in this whole area, Greg Fitzgerald, who's been there for about 2 or 3 years, I think. And it's a £2.9 billion business, sort of aiming to get its net debt down to about 100 million. And it trades at a PE of about 9.5 times.
So some similarities to the Springfield thesis, this focus, and they're sort of the rock stars going really hardcore on it, and they're going to go for 100% social housing model, whereas they're 50 today. They're really doing that to have a higher ROCE, slightly less volatile, more predictable business than they had. We think that's quite attractive. You know, some of the issues you flagged about house builders are why we don't like some of them. And also, you know, why we like the Springfield thesis is they're coming out of the big capital item work and going to stuff that's a bit more predictable and cash generative. So with Vistry, you're going to get quite a simple business that almost will end up being valued on an EPS PE type multiple rather than a NAV, because eventually there won't be much of a NAV because they're going to stop building things with their own capital and own land and really do it for the government and the councils and the social housing businesses. We quite like that. There is a theme in our portfolio and thinking around interest rates going up means that the price of capital and the price of time have both gone up a lot. So actually owning capital, you've got to have a much higher bar of return on it to match the sort of cost of capital.
Yeah, agreed.
Back. Now, that's quite hard to do for a house builder where margins are skinny and it's a tough cyclical market. So we quite like the idea with this one of, okay, capital's expensive, let's sell it and give it back to the shareholders. They can allocate it themselves as they see fit. And I think they've committed to returning $1 billion over the past 3 years. That market cap today of 2.9. So about so we'll give you that, and we'll stick to house building on a much more capital light model to match the much more higher price of capital, you know, per 2021. And we think that's really backable and quite interesting and differentiates the business versus its other listed peers. And then I think medium term, I suspect the Labour government's probably quite helpful for them. And that drives your earnings up beyond the sort of transformation story. So we like that one. Bit more of a lighter touch thesis. It's not an Onward where we're a bit more active. It's in our small cap fund, but one to sort of tuck away in the SIP and look back in 4 years or something.
Yeah. And also it's a more of a higher beta play on the on interest rates and the economy when you talked about sort of the the asset managers. Because if we do get interest rates coming down as they're anticipated next year, these things are going to go through the roof because they've been battered as interest rates rise. I mean, Vistry's up over 6% again today. Now, let's go to another sector, which is sort of like, you know, business services. And we've got Rosenblatt, or now it's RBG, and this really has been through management turmoil. It's a sort of legal services business. I think it specializes in dispute management. Made a couple of acquisitions, didn't go well. The shares have been totally mullered. What's your sort of like? This has got to be in the turnaround. Sort of like needs a bit of the Hulse magic to help the company recover, I guess.
It's definitely in the sort of one for the brave camp, and sort of saying that lightheartedly, but you know, this is not 8% of the fund. It's staked accordingly, but this is a deep value special situation now where if we're right and if the management do what they think they can, has the potential to be a real sort of high return investment. And that's really because of what's gone on in the past has depressed the valuation of the company down to I think a market cap of about 15, but an EV of more like 40 because of the debt, and we'll come back to that in a minute. But that market cap of 15, that's in the light of a core law firm within the group, which we think is really high quality. We think one day it could probably do an EBITDA of 15 itself, and it has done about 14 before in the past. You know, law firms trade anything between 8 and 12 times. So that I'm sort of setting the scene on certainly, you know, the positive outcome. I think what investors need to be really wary of and think about in the near term, and what we've spent quite a bit of time on, is what's gone on in the past, the level of value destruction, and what that's done to the balance sheet. So what would I point out to investors? So lots of management change. Nicola Fulston gone. Probably quite dangerous to comment given it's a law.
Yeah, I wouldn't comment on that one. No, don't.
But just look at what the share price has done. That's fact.
Exactly. Yeah.
But really, what happened over the past 5 years is you had a core Rosenblatt law firm that's tacked off into some different areas, corporate finance,
that's right,
funding, bought another law firm, and actually it was diversification in hindsight, quite clearly. Our thesis is back, you know, a bit of a similar theme to one of those ones you talked about earlier: stick to the knitting, back to basics, do what you're good at, and do lots of it. We really like the return of Ian Rosenblatt, the namesake. whilst he's always been a lawyer at the firm, he stepped away from the board. He's now returned.
Yeah.
He's a bit of a force of nature and is really nicely complemented by John Divers, the CEO.
Yeah.
He's a real safe pair of hands and kind of honest Scotsman. And Kevin McNair, the FD, who is a proper recovery restructuring specialist. And that's really what this needs.
Yeah.
The core Rosenblatt business does EBITDA margins of 30 to 35. What we really want to see the company do is go back to focusing on that, throw off an EBITDA of say 10 million, 12 million, maybe 14, 15 one day, and use that to pay down the debt, which is high, it's 25 million, but crucially, and this was part of our thesis and what we spent a lot of real time sort of thinking about and gaming out, if a bit of game theory really, HSBC have given them 2 years on the debt. It's an attractive rate versus the leverage. That 2 years, the business can start using the cash generative, high margin earnings, because they've now crucially got rid of litigation funding. They're winding down other parts of the business that were sort of margin dilutive. They can start paying down this debt, and a bit like Springfield, you can get an enterprise value to market cap transfer, but you'll get, in this case, that's not where the story will end, because actually, even if you get the current market cap of 14 and the current EV of 40, if you get the market cap going up towards 40 on a multiple neutral basis, we actually still think once that's done, the perception of the business will evolve and improve over time. And actually, you should get an EBITDA multiple near a 7 or 8 for this business, and your listeners can do the maths. It's definitely one. It's one in the high risk segment of the stable. That's why we staked it accordingly. But very, very cheap now, and just had a real tough time. But credible people at the helm trying to sort it out.
Okay. What's the sort of the underlying working capital cycle of that Rosenblatt business? Because the problem with law firms historically is that you charge out, nobody pays you, and you sort of like get your debtors sort of like debt collection sort of 6 months or 3 months. It isn't a rapid cash realization from invoicing.
That is definitely a challenge, and again, one to observe. And it's probably why net debt hasn't come down this year like you might have liked to in certain parts of the business. What I would say, they definitely benefit from the fact they are dispute litigators themselves. What I should add is Rosenblatt's quite a specialist law firm. They represent people in disputes and fights, really. So they're probably higher up the creditors list to get sorted.
Okay, gotcha.
But definitely right to flag. And as I say, this is a balance sheet cash flow story from here, and it's now over to the management to deliver on that.
Okay. Good. Okay, well, let's move to the online side of business service. We've got Trustpilot, obviously that iconic sort of online reviews for all things companies. It sort of now seems to have turned a corner, got into profitability. Shares have done pretty well. And hasn't like just recently. It seems to be on a bit of an upswing, actually. What's your sort of view on this one?
This is one of the sort of lighter touch theses. We're backing stuff, what's going on, not getting involved. You're right. There is a really good sort of review business there. We think within that, there's probably an emerging sort of consumer behavior data asset building where they actually understand that there's probably some learnings and insights that the right person could come and monetize at some point. But that's a longer term sort of story. More near term, what we really like, a bit like the comment on Vistry, it's a business that's changing its strategy to marry up or accept and adapt to the new world, which is one of higher cost of capital, and time and money is more expensive. So loss-making growth doesn't really work at the moment.
Yeah.
And really what Trustpilot have done, you talked about going to profitability, that's because they've not gone X growth. They've just dialed down the growth spend so that the marginal element of the growth that was, cost of customer acquisition goes up the higher you turn on the jets, and they just dialed things back to a growth level where it's profitable, and it's now quite quickly, as you flagged, dropping through to the bottom line, and investors are really responding to that, and as they should, because it's a bit like why with Angling Direct we're nervous of the European angle. Loss-making growth doesn't work, certainly not for us. But actually, if you look at what shares are doing, people want to see pound and pence return on money spent, whereas they did for the past 15 years. And Zilla, the new chair, is really leading this initiative. The founder, who was probably a bit more blue sky and evangelistic, has come out of the day-to-day running. And that's how you're seeing this profitable growth. And as long as the growth does continue, we obviously think it will because we've been buying the shares, this will now drop through and the profits will go up disproportionately quickly and should get to a 20-30% EBITDA margin. It's not the cheapest stock we own. I think it's on 2.5 times sales.
Yeah.
Actually, I think people are pricing in that, when this is fully profitable and mature, it's a 3 to 4 times sales business. So actually there is upside even in that multiple. Yeah. But yeah, going through change, we like it. We like the focus on profitability, and so does the market, clearly, because all of a sudden the shares are finding some attention.
How reliable are their online reviews as such that, because obviously you get lots of skeptics. It seems to be, I mean, obviously their customers are the companies who pay them for those listings, and likewise they get advertising. And then you get me and you who review, I don't know, a toaster or a telly on there or something like that.
I hope you were doing some of your Marks Electricals reviews on that you were tweeting.
Yeah, they are. Yeah, no, they're very good. Yeah, they're held out. Yeah, too right.
Look, how we as a sort of a very small shareholder can get involved in that? Not too much, but I think there was definitely a period 2 or 3 years ago where this was quite a problem and was almost quite rife in both senses of the word. I think a few dirty tricks around people getting the competition slated unfairly, but then also goosing up some overly romantic reviews of their own. Yeah, there's definitely initiatives in place in the business to really vet this sort of stuff now. As you say, the money comes from actually the operating company that wants to be hosted on the system. Yeah, but as you say, it would be dilutive to the value of the proposition of Trustpilot if the scores were a bit boosted and misleading. And in fairness, there are alternatives to this sort of stuff emerging, and FIFO, things like that. So we think for now it's in the price. I think that's a challenge when it comes to 4 or 5 times EV sales, but at the moment it's mispriced even on that basis.
Okay, good. Okay, well, let's move to software and technology. Last 2 companies. Let's start with Team 17, which is one of the bigger sort of games, sort of online games developers. I mean, these were pandemic darlings when everybody was locked down, and then obviously the last 2 years the whole sector has started to unwind. We've had big profit warnings from Tiny Build and Frontier Development, and these guys likewise have suffered. But they're now trading, if you believe the numbers, on 7 times PE with 45 million of cash on the balance sheet. So they're not exactly expensive. What's your sort of what attracted you to this? Because obviously, you're sort of like going into that bottom part. You're doing a bit of angling direct bottom fishing here, I guess.
This is a very, very recent one for us. We nearly weren't sort of able to talk about it today, but you've really set the scene very helpfully, Paul. The sector's been through a tough time. Team 17's earnings hadn't really caught up with that, and suspected that ourselves. So despite liking the business and looking optically cheap before the profits warning, lo and behold, the E or the EBITDA that those multiples are based off weren't right. They've now taken a revised view on that. I couldn't hand on heart say that there doesn't need to be more of that work going on. New team going in. There's definitely a risk of further headwinds to earnings, but on a P of 7 before you factor in that big cash pile, on an EV/EBITDA of 4, starting to take the view that even another small downgrade is probably in the price. Team 17 I've known for some time, but some former colleagues were big fans of the business, and it's one of the better players in this space. I think what's interesting though is Frank Sanger coming in, and look, this is another theme of what we do. Good people who know much more than us. Getting to grips with situations. Frank, he oversaw the disposal of Codemasters a number of years ago. He's come in, he's buying shares, he knows the sector inside out. He's a proper, sensible operator. And it's giving us the confidence that this could be a kind of earnings and multiple trough type scenario. There is a lot of consolidation in the sector. I think this is one that's definitely vulnerable to that now. It's got a share register that probably leaves it quite vulnerable as well, because everyone's been caught a bit flat-footed, all the long-term holders. You're seeing that in the way the shares responded to the warning. It was a really ugly move. But there's a good core business in there. Again, slightly victim of diversification, some M&A at the top of the cycle. It's a familiar story. Always watch out for that. with a business for the listeners we do.
Yeah.
But this is becoming a deep value story now, and a deep value story in what's quite historically been a good asset, a good company, not a sort of value trap lobster pot.
Yeah, no, I mean, I would agree. As a recovery play, it looks like it's a safer one. It's got a rock solid balance sheet, must have some decent franchises, ownership, IP, and it's the titles it owns. I know it does some third party sales as well, but for a gaming company, if you want to get into the sector, then it looks the most sensible option. I did notice the shares are up 8% this morning, so you're already on a nice little profit there. Right then, finally, then we've got. Basically maritime AI powered sort of information services business, Windward, which I think listed some time ago at 155p. The shares are about half of that currently, run by I think quite a charismatic Israeli CEO, and obviously a lot of the Israel, if nothing else, is very, very famous for all its military and information and technology sector. But a lot of the software seems to be used by coast guards to help sort of like coastal defenses and monitoring, but also they've got the sanction busting in terms. What's attracted you to this? Because it's still got some way to go for its path to profitability.
It has, but that at the moment that path getting or shipping lane is getting shorter and shorter by the week. There's been a real flurry of contract announcements lately.
Yeah,
that seems to, from management on the road this week, that seems to not be a kind of one-off right time. I think that's a part of a wider cadence that's going on and continuing. And all because it's a 99% recurring ARR business, all these contracts are just additive and bring forward that path to profitability. What's our thesis? What do we like? What's attractive to this one? I'll admit it's up there with Transense as one of my sort of not darling stocks in the portfolio, but really like what they do, and it's very interesting and it's fascinating. I mean, some of their customers, it's all a bit black ops actually at times. The core of the business to date has been what you flagged, which is they have a software sort of platform and system and data point tracking, which really monitors a number of effectively bits of telemetry around the global shipping fleet. So where are ships going? What are they doing with how are they behaving? Is there some unusual behavior with their movements or what they're doing with their trackers, their sort of LiDAR type systems? What's the history of the ship? If a customer wants to potentially hire a tanker to use it, are they at risk of breaching sanctions? What's its history? Very, very involved. And again, a simpleton like me can't do it justice, but I would encourage listeners to do some snooping around.
What type of information does it collect then? Obviously, it's got its GPS. It probably tracks it using Google as well. It's got ownership, and it needs sort of like what cargo type it's actually transporting and the destination. I mean, how the hell does it get all that information?
So it that's why their gross margins are slightly lower in the 80s rather than the 90s, because they do buy in some of this data that they need around what's on these ships, what's been on it the past 10 years, who owns it, who's leased it last. What they are able to do is sort of almost develop some predictive insights off the back of this stuff too. And really what their customers are, the current customer sets are a mix of government agencies really looking for either sanctions breaches, or sort of illicit smuggling, that kind of activity. Recently signed up the Argentinian Coast Guard. They've got all the US agencies, a lot of the European ones. That's the sort of core of the business. You've then got, if you think you're shipping all around the world and you need to really make sure you're not going no Iranian oil in the tanker, they've got all the big shipping majors, energy companies are signed up as customers. And then but what's interesting to drive the shares forward from here. So I think that core not legacy, that core bread and butter business can really see them get to a more than break even, but profitable business with a turnover probably slightly 50% higher from here. But what's really exciting, and could see this to be a share that's sort of £5 one day rather than I think 80p where it is now, is they are using the technology, albeit with some modifications and investment in R&D to improve the tech stack. They're taking what they do for coast guards and what they do for energy companies around ship traffic movement and behavior, and developing a supply chain predictive logistics tool, i.e. if I am, I don't know, if I'm Halfords and all my supply chain is in China,
Mm-hmm.
it would be really handy if I could minute to minute live monitor and therefore predict when my stock is going to land.
Agreed.
They are getting some really strong early success here, some early customer wins. I think you'll see a lot of that in the January update, and there's some talk of it in the most recent update. That's much more scalable and therefore exciting, and I think that's where you might end up with a sort of $100 million turnover business one day versus more like 50 with the bread and butter business. And Ami, the CEO, has just very recently moved to the UK, I think literally this week, to base himself here full time where our head office is. The business is gearing up for profitable growth now. As you said, I think it floated at £3, got down to 40p, where we sort of started building a position over the summer. It's on 1.5 times EV sales, I think, at the moment, but it's the highest ARR percentage business on AIM. And we think we'll get profitable quicker than brokers believe. And actually, the company are very clear about that. It could even be next year. So real genuine IP, very driven team and business, very interesting what they do. Structural drivers around compliance and sanctions, supply chain complexity. I mean, this China plus one and reshoring work is just making supply chains more complex and therefore more important to monitor. And we've been sort of buying the shares accordingly.
No, it does. It looks absolutely. It's not only got the IP and all that information and the benefits that you can, demonstrate to potential customers, but also with that network, and the bigger it gets, the deeper the moat, isn't it? So it becomes the barriers to entry become just absolutely huge for anybody else. So anyway, it's fantastic selection of growth and deep value, and some sort of special situations with turnaround. So big pat on the back. In terms of sort of like things that investors should avoid for 2024, what would you say is sort of like, I mean, obviously you don't want to be too cautious in this environment because as we both probably are quite positive on small caps, what is sort of like things that people should just be a bit hesitant on?
Well, good question. Multi-million dollar question.
Look, what about debt? I mean, debt is that if interest rates are coming down, is it best to still stay cautious on debt?
Yeah, although I think you can sort of start to take a view now that is it more than in the price? I think that was definitely the argument 12 months or so ago. But the things have definitely stabilized there. For me, I would be looking out for businesses where management are hesitant to put money in their pocket despite what share prices have done. There was a bit of a theme today around directors recently buying. They tend to be slightly early because they're not investors, they're business people, but they do know the ins and outs of the company and sort of do what they do, not what they say. I'm always a bit wary where a share price is really beaten up, and even then management sort of trot out some kind of excuse why they're not buying the shares themselves, but want the shareholders to, and are frustrated they aren't. I think no one's expecting people to write huge 6-figure checks, but even if it's just topping up your SIP consistently, that's what we like to look for, is skin in the game and alignment. And I think it's always the signs are there if management are wary or even selling shares. There's scenarios where it's justified or explainable, but always a question mark.
Okay, brilliant. Okay, well, as I say, brilliant stock ideas for people to do a bit of deep research over Christmas, jumping into their turkey and a few nice sort of mulled wines, to say the least. Now, if somebody wants to invest in the Dowgate Wealth Fund, say that the Onward Opportunities, how best to do that, Laurie?
So Onward Opportunities is a listed business itself. It's got a ticker, which is ONWD, Onward. It's listed on AIM. You can sort of buy and sell the shares. That's the way to invest in the company, and really these stocks we talked about today and some others that are coming down the track. And that's very easy to do from a sort of typical sort of stockbroking or retail investment platform. If people are interested in more sort of wealth management or SIPs, ISAs, that kind of sort of financial advice, just hit up the Dowgate Wealth website, and there's a great contact us form where some of my esteemed colleagues will be able to help. And that, they're the ex-Hargreave Hale team. So really, you used to look after Giles Hargreave's private clients.
Brilliant. Okay. Well, again, thanks very much for the great insights, and happy Christmas. And I hope you have a great new year.
You too, Paul. Merry Christmas.